where you see the bulk of the pressures has been, for example, commodity price impacts on Asia. Asia is a large importer of commodities, so that's been felt more. Obviously, all the myriad of China-centric risks has weighed more on this region. So when you look at equity pricing, Asian equities are trading cheap compared to global markets. And, what we're seeing in the recent data, we just got the recent set of PMI data from the region, and it's the first time since probably sometime before COVID that every manufacturing PMI for every economy in the region is back above 50. So it shows the region is recovering. If we could just get some of these other risks, particularly stemming from China, easing, then the markets do have some room to recover here and will be supported by a continued reopening of the economies and global recovery. So Asian equities can really do well. We really don't disagree with the high yield bonds either, because there is a complete mispricing of risk in that market. At the moment, you have global investors arbitrarily just selling risk in that market because they just don't know how to assess it. And so you have numerous babies being thrown out with the bathwater, as they say. And the default rates being implied by some of the pricing is something like 50%. And it's highly unlikely to ever get anywhere close to that. So we do think there's a lot of opportunities in that market, but it's going to be an exceptionally bumpy road and may take a while before you start to see that being realized. No disagreement with the view on IG bonds, because pricing in the IG market, there's been a very strong flight to quality. So pricing there, spreads are very, very tight. And of course, as we move forward and you get the normalization in policy and US rates increase, there will be this drag from the underlying rise in US Treasury yields.